economies and some of the challenges out there. Of course, the government debt is going to be another issue. And of course, the global geopolitics definitely is going to be impacting our future. Are there bubbles out there? And Tom and I will address some of that. And then, of course, we're going to look at the lead and lag indicators and what they're telling us. And of course, we'll end the whole deal today to talk a little bit about wisdom. We do that in our lectures. And again, we would like to do that. So Tom, I'm going to kind of kick it off and I'll intersperse you here and I'll kind of take the lead and let's kind of look at what's on the horizon. I think one of the things that is, bankers, and of course, if there's some business folks, board of directors in here, we are definitely into global economic trade and transition. After World War II, up until the economic crisis of 2009, 2010, we were definitely into globalization. And but since that period of time, we're into deglobalization. And one of the things is the pandemic and also supply chain issues has really, really accelerated it. And so as you look at your customer base out there, you look at your consumer base, how dependent are they on globalization? And this is definitely one of the aspects that you're going to have to consider. Second element, ESG. If you're not discussing this in your boardrooms, if you're not discussing it with your customers, you need to be, because basically what's happening all the way from the Walmarts to the Krogers, we have activist investors. We also have consumers out there, and they are holding people compliant to environmental, social, and governance. And again, this is a big movement that is accelerating globally. I was just with a group in Sweden, and they're about 5 years ahead of us. The other element that is very critical, it was critical in the 70s, early 90s, and of course it is today, we're seeing the oil and energy complex in a major transition from fossil fuels to green energy. My contention is they're out ahead of their ski in this. And what's happening is you've seen a dramatic ramp up of oil and energy prices. And this is one of the contributors to inflation that's possibly not going away. And if you think after 9/11, the United States became the #1 energy producer in the world in a matter of 10 years, Canada 4th, Mexico 8th. That's all being unraveled. And unfortunately, it's one of the aspects that's really, really impacting our inflation. The other aspect is labor shortage today. I was in Nebraska last week, signs up everywhere. And one of the things that's happening is while we have a labor shortage today, don't be surprised. Somewhere in our future, we're going to have a job shortage because one of the things that goes back to basic economics, when labor becomes too expensive, what do you replace it with? You replace it with capital. And on the drawing board of Walmart's, Kroger's, and various organizations, they're looking at cutting their labor force by 30%. And, Tom, you've got some pretty good insight in this area, and you want to talk to the group of some of your insights here.
You bet, Dave. Thank you. And that is a great insight that you have. And as Dave mentioned, he's kind of looking at that long-term cycle. We talked a little bit this weekend about that cycle may be a little shorter term than we think. And I'm going to kind of introduce a term here to you all and see what you think. And that is that there could be a bit of a whiplash effect in this economy as we see it today. Of course, we know we have the severe labor shortage. We also know that, as you all can see by your still very high levels of deposits, that there's a lot of cash out there on the sidelines. We'll get to that a little bit when we talk about the velocity of money and where we sit with the money supply right now. But with all of this stimulus that we've had with the not just with the accommodating policy on the Fed, that's been a part of it, but the physical stimulus of the economy has provided this additional money for folks, and they're spending it to some degree. They're saving it to a large degree. But to the extent that that's getting out there, then that is what creating this new demand. And then, of course, supply chains have been hampered due to the pandemic and the lack of workers in a lot of sectors. And when you look at the supply chain, somebody said a week or two ago, Dave, they said they were talking about the supply chain industry. And I thought, well, it's really not so much an industry, it's just ubiquitous. And when you get a hang up in any one piece of it, you've really impacted those customers of yours that are out there dealing in all kinds of businesses, not just manufacturing. So this whiplash effect could very well be felt next year as we start seeing people have to come back into the workforce as some of this excess funding and stimulus subsides and they feel it. You know, so many people today, and you see it in your banks, they live paycheck to paycheck, and there's a little bit of a lag there. When they start feeling that, they want to re-enter the workforce. That's about the time that some of this demand may be falling off. So we could see a trend back in the other direction with a tightening in the job market later next year. And this automation part, and I'll just close with this on this segment, that this automation, you know, this is good that it does add to worker productivity. That could be a dampener for inflation as we get out into the year next year, but it would cost jobs for particularly lower skilled people. And just one more comment on this one. There is that great resignation that's been taking place. A lot of job switchers, some that are just going away. But here's the thing, and I think you're going to hear from it not only personally, you're going to feel it in your banks. You are now. But what your customers are saying, particularly small business customers, where they're hurting is with the quality of employees. 29% of small business owners say today, a survey by the NFIB, that said that quality is their top problem. That's the highest that measure's been in 48 years. Just saying the quality, the skill sets, the work ethic of workers is their biggest problem right now. So with that, I'll turn it back over, Dave, and we'll move along.
Well, and I'll summarize it like one of the bankers told me the other day. He says it's not a labor shortage; it's a labor ethic shortage. And again, the mundane task. It goes back to the Taylor principle, as we used to study it in the Industrial Labor Relations School at Cornell. We're going to replace the mundane task, and so there's going to be jobs out there, but it's going to be at a higher skill level as we have the technology, the biology, the engineering, and the information come in. Well, Tom, one of the things that is that definitely been, and this is something that Chairman Powell's really wrestling with. You know, we did a double barrel approach to keep us out of a depression worldwide. And it was worldwide. We not only had accommodating central banks in the United States and around the world, but then you couple it with the stimulus. And I want you to think about this. The $85 trillion world economy, and this is the world economy, 14% of it came from a government check. And that is not sustainable. And what happened was we had a lockdown. So many people, what did they do? They saved it, or you're seeing it in deposits in your bank. In the United States, it was about $2.8 trillion. And so this is something that we're going to have to watch real closely over the next 12 to 24 months to see if some of those monies come on out. And so, again, it was the double barrel approach. And as the Fed tries to tame this genie that's out of the bottle, you know, we've never done the double barrel approach like we did it this time, Tom. The other aspect is we have weather extremes, and Tom and I were talking about this last night. Our condolences to the people, you know, in the Mid-South. I flew through that, a 767 jet the other night, and it was rough, but it was a lot rougher down there. And our condolences out to all the people that were impacted there. And again, banks, let's step up to help folks. But you're going to continue to see the weather in extreme, and again, that is going to place this carbon footprint, you know, on out there. Let's go to China. China really has some real estate challenges. And I'll come back to that in a minute, but that's one of the things that really, really drives their economy. And again, this could be a disruptor of the second largest economy in the world. Now let's go political military. We've got two fronts. Right now, Mr. Putin in Russia, he's massing troops, and Tom and I were talking about this last night on the border. Now, this is where he can flex his muscle because he knows winter's coming in Europe, and there's a critical pipeline going into Europe. And so this is the way that he can really, really show his power on a global stage. Let's go to the other side of the world. China right now is struggling economically, not growing as fast as it historically has done. And their economy has gone from about a 7.9 to about a 4.9% growth rate. Now, if that continues and if they continue to struggle, President Xi is coming up for his third term. One of the ways that he can quickly get the populace to nationalize is to flex his muscle into Taiwan. So that's one of the things we're really, really going to have to watch as we move forward. And then, of course, these supply chains. Think about 74% of the electrical components in the electric vehicles come out of China. Think about when we pulled out of Afghanistan, $2 trillion worth of rare earth metals are in the Afghanistan area. And so these supply chain issues as we move forward are not going away. And everybody's focused on the ports. I focus on my friends, the truckers. And you could see this one coming loud and clear, Tom, a few years ago, talking with my truckers when the government started regulating. The bunch of baby boomer truckers said, I'm out of here. And now we have a tremendous trucking shortage. So this portends to seeing these supply chain, marketing chain issues continue. So again, these are 10 disruptors. Now, Tom, let's go into the $1 trillion question, inflation, inflation, inflation. Here are the numbers. And, you know, everybody said it was temporary. Tom, it's almost going to be with us for a year now. And whether it is core inflation, stripping out food and energy, and then headline, putting in food and energy, and also coming out tomorrow, December 14th, we're going to have producer price inflation along with, and I'll have Tom talk about the dot plot tomorrow, but this is definitely with us. And you know, this graphical approach really shows it. And you got to keep in mind, we went for a number of years where inflation was basically very, very tame. And so your businesses that you loan to, your consumers out here, the inflation shock is alive and well. And, you know, Tom, the big question becomes, you know, I'm asked, is the inflation similar to the 1970s, early 80s? Well, if you look at that time period, it was post-war, World War II, we were into globalization. Again, here's our old friend, oil and energy. We had that caused by tensions in the Middle East. But the baby boomers, I'm a baby boomer, Tom. I think you're a little younger than a baby boomer, but one of the things is we were buying our cars, our houses, and you know, our wages were increasing. And again, we had accommodative central bank policy and the M2 and the velocity of money. We were chasing those goods out here, and our friend behavioral economics kicked in. Buy now before the price goes up. Now, let's fast forward decades and look at the inflation today. Here's our friend, fossil fuels, and the transition to green energy this time. We're deglobalization. And so this is creating some shortages out here. And of course, Tom, you mentioned the supply and marketing chains along with the labor shortages. And then we pumped all of this money along with accommodative central bank. And so this inflation is with us. The one thing that we will have to watch very closely is us baby boomers are moving into the later stages of our life, and our spending habits change, and they tend to be more conservative. So the $1 trillion question is this temporary or permanent? Tom, I would say there's some permanency here, at least for 12 to 24 months, as we work through the supply chain issues. And as the central bank out here walks that tightrope, rate increases, price stability, unemployment, and not throwing us into a recession. And the other thing, as you mentioned, our automation type of aspect. But Tom, I bet you everyone tuned in here to get our thoughts on rate increases. And we've got some big meetings coming in the next couple of days. Tom, I'm going to pass the baton over to you to talk about the dot plots and some of the things that they really need to kind of watch. But here's the big $1 trillion question. By the time the school starts down there in Baton Rouge, will we see the first rate increase? So Tom, over to you.
I knew you might put me on the spot on that one, Dave. Well, great discussion, Dave. Very informative, and fully agree. The supply chains are coming. We're going to come a little closer to home with some of those supply chains, and you see that literally at home. A lot of folks have been purchasing some of those energy or that backup power supply for their houses. Just kind of think about that in terms of shortening the supply chain for whatever purpose it might be, and we'll see companies doing that in years to come. With regard to inflation, I think we think about it this way. There are several layers to it. One is this word transitory. I'm kind of reminded, Dave, of what John Maynard Keynes said. In the long run, we're all dead. And I think inflation is that way. In the long run, everything's transitory. The question is it going to be transitory enough for the Fed not to have to act? And I think the answer to that is clearly no, that the Fed has probably already waited too long to act on this inflation. It was interesting, just not too long ago, Chairman Powell had said that our worst problem, or our most difficult problem to resolve, was low inflation. Well, I don't think that's the problem anymore. Think about it this way. We have had this stimulus that has been inflationary, and as has the accommodation that the Federal Reserve has enacted. We used to call that, there used to be a phrase for that, it's kind of come out of vogue, maybe it'll come back. It's called monetizing the debt. That is, the federal government issues debt. Interest rates would be pushed up as a result of that, but instead, what happens is the Fed is buying that. In fact, just during the pandemic, that balance sheet of the Fed has increased another $4 trillion just in the last few years. So we saw quantitative easing, we started seeing some drain off of the Fed's balance sheet, and now we've seen a dramatic increase in it again. So that is certainly an effect. Are supply chains in effect? Yes. So there's no doubt that there will be some self-resolution of that in the supply chain as some of those supply-demand factors come more into balance. But there are some longer-term, as Dave said, effects. So I think we will see inflation into and through next year, probably not at the 6.8 we see now. The Fed is looking at not CPI, but CPE, and looking at that measure, that's a little bit lower because people tend to switch out of products as they get more expensive, but that's still running above 5%, so definitely an issue for the Fed. Now, back to the dot plots. Think about it this way. Money supply has been increasing, and velocity of money has been coming down, not quite at the rate. So we're starting to see that inflation on the other side. We have seen it. The dot plots are going to be very interesting this week. So 2 o'clock Wednesday, watch for this as the Federal Reserve puts out its bit of a projection about where rates are going. And the dot plots, for those of you who may not be familiar, are just each one of those members of the FOMC, voting or not, are going to make a prediction as to when, how much, and by when will rates go up. If we look back at September, only a few thought that rates would increase 25 basis points, and we're talking about Fed funds now, in the next 2 to 3 quarters into 2022. Now, we had a few that by the end of the year, just a handful said, well, I think it'll go to 50 basis points by the end of 2022. I think we're going to see a major shift Wednesday in those dot plots projecting that we're going to have about a 50 basis point increase. There's a very high probability of that during 2022, as much as probably 75 basis point increase in the short term. I would look for some of that to come earlier rather than later. They're going to have to do this fairly soon to get a handle on inflation. As you all know, we'll take a look at employment here in a minute, but employment growth has been strong, perhaps not as strong as we had hoped or as rapid as we had hoped, but the unemployment rate has come down. So the Fed, as far as its mandate, has really, we're taking care of that one. Now we got an eye on inflation. So take a look at or look for those dot plots to start predicting the majority of those Federal Open Market Committee members, Fed governors and district bank presidents saying, yes, we're going to see rate hikes in the coming, and I would say in the coming first and second quarter of next year, followed on by 25 basis points at a time later in the year.
So Tom, to summarize and confirm what you're saying is we'll probably see 25 basis points by the time we start school down in Baton Rouge in May, and then maybe 25 or 50 basis points later on in the year. So good high probability of 50 basis points, but then possibility of 75 basis points.
By the end of the year, yes.
Yep. Wow.
And I would even say by the start of school, we might even see 50 by that time. I think they're going to have to be a little more aggressive than what was earlier anticipated. And of course, as always, as anyone who speaks about the economy, the data should drive the decision. Should have already driven the decision. So we're waiting to see some action. So the point being that we're already delayed in action that should have occurred already. So we've got at least a 25 basis point catch-up one to play out, and then we'll go from there.
So all of our alumni that are sending students to school, make sure if we get it wrong, I'm sure we're going to hear about it. And
we'll hear about it, won't we?
Yeah.
And by the way, Dave, you mentioned that, if we look at the yield curve right now, we do have an upward slope, right? But we've been kind of focused more on the short term or short end of the curve. The other thing that you'll see discussion tomorrow with the Fed meetings and Wednesday will be, it can't just be focused on the Fed funds. So we'll hear a lot more about tapering, slowing down first. We got to stop this train before we can get it in reverse. So slowing down the purchase of bonds and mortgage backs, and then pulling back, shifting that into reverse and shedding off some of this 8.7 trillion that's on the Fed's balance sheet right now. Yeah,
and speaking of that 8.7 trillion, a couple of folks have asked a little bit about the debt. Is this debt and deficit? Give us a little perspective there, Tom. And again, I'm calling a Peyton Manning audible. We're going to cover a little bit later, but we did get some questions. How does this deficit, how's this debt compare to World War II debt or the Great Recession debt? Go for it.
Yeah, that's a great question. Putting things in perspective, and that is very important, Dave. I think I really appreciate you for doing this. You always at the school make it a point to talk about, we've been in places, maybe not exactly this place, but we've been there before in terms of economic difficulty, economic cycles and waves. And so this is no different in that the reasons are different. The outcomes will be somewhat different. But in putting it in perspective, think about, we've had a debt build over the last couple of years that is, when you look at it as a percentage of GDP, we've gone from about 105% of debt to GDP just a couple of years ago to now 135% of debt, not talking just deficit, total debt to GDP. The build on that is about half of what it was during World War II. if you look at it from the standpoint of the percentage of debt to GDP. So we're layering on about half as much as we were to finance and and we were the arsenal of democracy for a major undertaking, obviously in World War II, financially and in terms of life and treasure. You compare it to the Great Recession, it's about double what we were doing in terms of layering on, if you looked at it year on year, deficit to GDP. So that kind of gives you about half as much as World War II, twice as much as what we were using as stimulus. And by the way, one issue with this too, and Dave and I talked about this, there's not a lot of chance of getting this money back. In other words, this is not a capital purchase plan where the government will get a return on that investment, even though obviously very risky at the time, didn't know it was going to come back. But a lot of that money came back to the government after the bailouts and all of that with the Great Recession. This money is spent. And so, now as we get into Build Back Better and all of those issues, again, layering debt, and the real question is, how much of that will be put to work to actually aid production, and how much of it is, again, just bleed off and more stimulus that could be also inflationary. So we got to watch that too. Got to pay real attention to this bill.
Yeah, and again, we're what, 28.5 trillion in debt right now.
Yes.
Think about it, at the start of the pandemic, we were around 21 trillion, and if we do the bill, it puts us around 30 trillion. And in just a little perspective, we're 145% debt GDP World War II. But what happened in that deficit spending, we were able to flip very, very quickly a military type of infrastructure to a consumer type of infrastructure. We sent the GIs back to school. We rebuilt Europe, rebuilt parts of Asia. And so that gave us that post-war boom that we had there. And again, we would kind of call this debt high cholesterol debt. It would be the, not the HDL, it'd be the LDL if any of our alumni have been going through there. So again, we've got to be real careful. There's three ways out of the debt: inflate it, grow the economy, or of course, default. And hopefully we don't go there. And so again, Tom, thanks for taking us, down through those type of aspects. But an interest rate increase, if we go up 7,500 basis point interest rate increase, the interest on our national debt becomes bigger than the military budget. So there's a lot of balancing. And if you look at World War II debt, much of it was with our bondholders, our citizens. Today, up to 40% of the new debt is foreign based. And so there's some different type of dynamics out there. So Tom, thanks for going down that bunny trail with it. Hey, let's go do a quick global walk around. And I'm very, very concerned about some of the trade agreements. If you look at it, China is very, very aggressive in their Silk and Belt Road Initiative, where they've invested over $1 trillion in 68 countries around the world since 2013. Think about that, since 2013. We had a chance to enter the TPP, or the Trans-Pacific Trade Agreement. China has applied. They're trying to receive ratification of that. I doubt if they're going to get it, because it's going to require Australia to sign off. And of course, Australia and China have been in a row. They also have the Regional Comprehensive Trade Agreement, which that is massive. It's almost 25% of the world economy. And so these trade agreements where we haven't participated in, it really hinders our global stance. And also, if you look at President Xi, he's coming up on his third term, unprecedented. He's kind of appointed himself leader for life. And what we've got to do is watch the Chinese economy very, very closely, because one, he's regulating real estate, regulating business, and regulating high wealth people, because now they're moving from authoritarian capitalism to socialism. And so it's going to be real interesting to watch how this Chinese economy transitions out there in the future. I tell my folks in the agriculture arena, where we've had record high cotton prices, 77% of our cotton's exported, we could go to record lows real quickly if China decides to shut down. And of course, I've talked about the nationalism through Taiwan, but let's look at their real estate sector. And here's what happened. They threw a bunch of regulation on the real estate sector. Some of the big developers like Evergrande really came into a liquidity crunch. And what happened during the Great Recession? A liquidity crunch. What happened in the 70s and the 80s? A liquidity crunch. And you see 29% of their economy revolves around real estate. 90% of the qualified households own real estate or own real estate to be developed, like companies like Evergrande. And so what's happening is that Chinese economy is really struggling in this transition phase. And then that ripples to Vietnam, Indonesia, Japan, and India. So we see this area of the world kind of slower type of growth than we have in the past. We go to the other side of the world, Europe and Russia. We talked about the pipeline and the energy and the possible military aggression. But our fourth largest economy in the world is in a major transition from Chancellor Merkel to the new chancellor. And one of the things is Putin's going to test that one. Also, Germany wants to become less reliant on global trade. And so again, that fourth largest economy in the world has kind of gone stagnant growth. And of course, we've had additional pandemic issues, which hits their tourism, which really drives their economy. So again, you have to kind of think globally, bring her down locally. Now, as we move on, Tom, everybody asks us, are there bubbles out there? And economic or financial bubbles? Stock market, cryptocurrency, commercial real estate, housing, farmland, my area. Tom, do you see any bubbles out there? And this is not New Year's Eve in Champaign.
Right. Well, I kind of feel like what Alan Greenspan was asked that question prior to the Great Recession regarding the housing market, and they said, well, is it bubble? Is it a bubble? And he said, well, it's actually more like froth. There's a lot of little bubbles, and there's a lot of different bubbles. With regard to some of this, I think on the commodity side, yes. The stock market, we have had strong earnings, and this has been supported by earnings. But here's the thing, Dave, that I'm concerned about is kind of a reverse wealth effect in terms of the stock market. And let's say this, if we're right, and over this next year, and assuming that we continue to stay in recovery, we may have maybe not stagflation, but we may have slowflation next year with the economy certainly slowing down off this pace. But as that occurs, if rates come up, that's going to put pressure on all kinds of asset prices, and including real estate, including the stock market, including the bond market. And so as that occurs, will we be able to maintain income streams, in the face of inflation? And of course, that's one reason that the stock market tends to perform a little better than the bond market in times of inflation with price adjustments and things of that nature. So yeah, I see some potential bubbles, but I think we really have to watch those earnings for those companies next year. And one of your favorites, we really need to watch this consumer confidence number and how it's playing out in retail sales, sort of past this pent-up demand stage, if that makes sense. Going into next year, as we sort of plane out and we get back to a little bit of whatever the new normal might be, will that retail demand sustain once supply chain issues kind of clear up? So I think that's going to be a key driver as to whether or not some of these commodity markets and stock markets are indeed a bubble. But if we do get that decrease in that market, look at this being kind of a circular effect, because we could have a reverse wealth effect there with asset prices diminishing. I do expect a lot of volatility in the coming months in the markets.
Yeah, and I'm right with you on this. And you think about that $7 trillion of over on the fiscal side, that's impacted earnings. I don't care if it's Walmart or whoever it is, and that's non-reoccurring, and that's what kind of concerns me. Uh,
Crypto. Hey, Dave, you mentioned crypto.
oh yeah,
Um, Dave and I are not. Is it fair to say, I don't want to put words in your mouth, but we're not big investors in crypto.
no,
But
no,
at the same time, it's interesting that and I hear a lot of investment managers talk about that as it's part of their portfolio, and they'll kind of hedge the fact that they're hedging right on crypto. But at the same time, it is an interesting phenomenon in this sense that perhaps it's driving some of the speculators out to another market and away from some of these other markets, whether that's bonds or stocks. But I didn't know if you had any other comments regarding
Oh,
crypto or.
Tom, I've got a lot of comments on crypto, and of course, many folks know I work the agriculture of the rural area, and
Mm,
I had a banker raise his hand at one of the banking schools this summer, and he says, "Well, one of my farmers increased his operating lines of credit, and he thought he was building liquidity. Well, he went out and bought over $1 million of cryptocurrency. It is rampant in the ag area. Dr. Woodland, if you're on here listening to me, I would have never expected it. And you know who the personality type is? It's a high D driver type of personality. And we are, the questions I'm getting, Mike Ewing is one of my former students on Mike High. The question is, how do we value cryptocurrency on the balance sheet? How do we put an advance rate on it? And I would say, don't put it in at 105%. It would probably have a low value. But cryptocurrency is definitely out here. And it's one of the things that it's gaining a lot of momentum in the footprint that I work out here. And so it's definitely one of the elements. And can I tell you, a number of folks say, well, I got these excess government checks. That's my play money. And so I'm going to put it in cryptocurrency. And so that's kind of the philosophy I see. So this is potential risk. And the other thing, China's trying to get their hands around it. Our Fed's trying to get our hands around it. And I've got to tell you, if we would have something that would disrupt the dollar, the yen, the euro, or the renminbi, cryptocurrency would gain even more power. And I think it's about 3.7 going on $4 trillion
Really? Mm-hmm.
into the crypto area. So I see some bubblish activities definitely going there, Tom. And I had to bring my experiences that I'm seeing out on the road. And Tom, we weren't talking about this down in Baton Rouge last summer.
No, no, I
And
agree with you. That is a source of risk with that level of investment and that level of speculation in a market. That level of risk is that not just the volatility that we see that these cryptocurrencies have, but if they take a major hit, that could take some other consumer confidence with it.
Exactly. And a number of young people are investing in cryptocurrency. And so, it hits all spectrums. But listen to this, Tom. I had a 90-year-old in Northwest Iowa come up to me, and he's a very wealthy farm landowner. And he comes up to me and he goes, "Hey, should I be investing in this cryptocurrency?" He's even looking at it. And so it's definitely out there. It's something that we need to keep our eye on, but it represents risk to the total type of economy. Farmland, I don't see a bubble there, though it's increased 20 or 30% in the past 6 months. A bunch of baby boomer farmers are buying up farmland. And that is one of the elements that gives resistance, because the baby boomer farmer have their financial legs under them, and they'll still invest for another 10 years. So that's our walk through the various marketplace. I guess, Tom, we'll go to the lead and lag indicators, and then I'm going to take a couple of questions as I'm going through these lead lag indicators. Hey, Tom, can I go down to unemployment? Because because that's really jumped you. U3 is 4.2, U6 is 7.8. It's definitely down there. And, Don gave us a question. What is driving the labor force issues? Baby boomer retirement, millennials not skilled, upward surge. One of the things I will tell you, the government wanted $15 minimum wage. They got it through extended unemployment benefits and, some of the stimulus checks. But where do you see some of this? Is it because us baby boomers retired? Where do you kind of see this going?
Yeah, Dave, I do. I think it's a little bit of all of the above. And, kind of like the frothiness. By the way, just to kind of flip back there just a second on the real estate, the commercial real estate, I know we've got a lot of folks interested in that, and the residential is, I do think that too is frothy. Just look for those, we have a lot of in-migration here in Middle Tennessee, obviously in the Nashville area, but even in some of the outlying areas, folks bringing money with them. Still a lot of cash deals out there. And we are hearing rumblings now of increased regulation on some of these cash deals, particularly in major metropolitan areas. But as we look at that, I would just say this, kind of go back to basics on that. Just make sure we're not getting over our skis in some of these markets. Right now, of course, loan quality extremely, extremely good, but don't get too overconfident with that as we start getting above the income capacity of sort of what's inherent in these cities. So in other words, folks moving in, particularly to our regions, most of us here in the southeast, as they come in with money, yes, they can bid those prices up, those rents are up. At the same time, inherently, we're only able to keep, in long run, what those income levels can support. So something just to be cognizant of in your local markets there. Commercial real estate, I would say, it too frothy because, depending on the type of real estate, you all know storefront real estate, retail, very different than commercial office. Office real estate opportunities there, a lot of restructuring, lifestyles of work being restructured. So there are definitely opportunities, but just kind of that fine, more granular look at the real estate portfolio, I think would be something that if I were in your industry directly, I would really have an eye on that. And I know that you all are out competing for those folks that can do that analysis. As to the unemployment picture, Dave, I would just encourage everyone to really focus not so much on that U3 rate as it has come down. We still have a lot of folks. We're still, we've got people still on the sidelines. We're still about 3.5 million jobs fewer than we were before the Great Recession started. And there's different ways of measuring that, but when we just look at the actual labor force, we're down about 3.5 million still yet. So some are coming back. But look at this one. Look at labor force participation as an overall economic metric, whether that's state level or federal, because right now our labor force participation is 61.8, I believe, and that dropped precipitously when the pandemic began. It dropped to 60.2, and again, that's 60.2% of Americans either employed or looking for work. Now we've climbed back to 61.8, but that's about halfway back to where we were pre-COVID at 63% labor force participation. Dave has put on the slide here that we have 4.2% on the U3 rate, the headline unemployment rate, 7.8% on U6. Those are those marginally attached workers. So even those folks, some of them they've stopped looking for a job, at least in the last month. They get counted in that U6. So I would pay attention to U6 a little more than I would U3, but particularly I would pay attention to the labor force participation rate. But all of the above on what's causing this labor force disruption and the slow comeback of the labor force.
And Scott basically had a question, Tom. How do we compete against all the tech companies in our area that pay much larger, salaries, and they're, coming into, areas like
Yes.
Tennessee and different things like this? And he's got a good point. HR is global and it's no longer local and regional. And one of the things is great article in CNBC over the weekend on the Great Resignation and forcing employers to kind of rethink. And I'll tell you, you're going to have to get really creative. And this is where upskilling, and just a whole host of, your work type of situation, to compete against them. It's going to be a big paradigm shift in the banking industry just to be able to compete. It's more than wages out there, Tom.
It's certainly excellent point, Dave. I'm glad you kind of cut that clip in there because it's more than wages for this generation. And by the way, I am baby boom, Dave. I'm just very, very young.
Okay, I'm very, very old.
So I'm very young for my age. But all kidding aside, yes. And Scott, absolutely. So had a conversation. In fact, I'll tell you this. Tomorrow evening, I'm meeting with some folks in Nashville with one of the big investment firms that have moved their headquarters from New York to Nashville in about 2 years ago. They made the announcement, they moved the headquarters. And so I tell my friends, around Nashville in the banks, community banks around the region, you're not just competing with your community bank or other community banker, you're competing with these investment houses. As Scott so correctly says, you're competing with tech companies, you're competing. So you'll have some sticker shock competing for some of those folks. But I would say let's zone in a little bit on what Dave said about this, and then try to find yourself some hooks. I would definitely, whether it's universities in your region, get to know them. Make it a point. Look at it as a recruitment tool to know those folks, to provide you, who will be providing you with a pipeline. And this day where we can just swap folks is it's getting very, very difficult, as you know. So I would look for that. We've been using some things that is great for partnerships. We have a student bank board where the students are actually getting out into the bank. The banks that are volunteering to do that, guess what? They've got some pretty good choices. And so I would try to line up with the schools, do what you can to recruit. And then, as Dave said, it's not just about the money. It is a lifestyle. I know those of us that are old school baby boomers that, we think, well, that's the way we came up. This is the way you'll come up. This is the way it's done. Pay your dues and do that. Just try to think again. Dave, I'm going to go ahead and put this in here because it's timely. That is that we typically end with some admonition to say, you are leaders. Continue to lead. And to lead, you have to read. I've read a really good book lately called Think Again by Adam Grant. And what he says is this, I love this phrase, confident humility. Be confident in what you're doing, but be humble enough to know that maybe what you've been doing needs to change. So kind of look at it that way. I know in our industry, it has been a very humbling experience, and we're doing the same thing with our employees and trying to adapt to this new environment and still get the job done. Keep your eye on the ball, right, Dave? I mean, what you want, productive workers, customers that are satisfied, those people you need to hang on to that can make that happen. So just encourage you in those ways.
Tom, I'm going to kind of hit, it was a great question. Are the traditional metrics that we're kind of looking at, lead, lag indicators, do they still work? No, they're kind of blown out of the water, but I'll tell you 2 or 3 I'm going to zone in on. Tom, you mentioned it. Boy, watch the consumer sentiment out of University of Michigan each month. And, during our 128-month economic expansion, the number was over 97% of the time. recent months, and I say recent months, about the past 5 or 6 months, it's in the low 70s, down into the 60s. Our consumer is not confident. That drives 70% of the U.S. economy. Watch that one from now out to about mid-June. It stays down in that level. That's going to kind of tap the brakes on various things. Another element that I'm watching very, very closely is, of course, those oil prices. They're kind of in that 65 to 80 range, but any little snafu internationally could move them to $125 a barrel. Any little snafu could move them to $40 a barrel. In other words, you're going to see a wide range of volatility in that area. Housing starts, as long as they stay above 1.5 million, that's 1 in 7 jobs in the United States economy. If they continue in that range, we're pretty solid. Somebody asked me about timber prices. Of course, we saw them go up into the $1,800 level, and then they came back down. That's going to be very dependent on some of our tariffs. People actually put their hands up and said, hey, I'm not building. I'm going to kind of postpone out there. Of course, the typical lead economic indicators like the PMI, Purchasing Manager Index, and the LEI, they are showing very, very positive. But you know where I'm seeing them slow is in China and in Europe. And will that filter over into the United States? And finally, on factory utilization, your issue there is we've had these bottlenecks in supply chains. In other words, we can't get this component to finish up the trucks. I got to tell you, the local Volvo plant here in Pulaski, Virginia, talked to the lady that cuts my hair, and she basically said only of 20 trucks that went out the other day, only 3 would start because of the quality of workers. They just don't, they're just not there. So that's a quick walk through the lead and lag indicators. And remember, if copper prices stay above $3.80 a pound, it still means a growing economy. But China is doing its classic example of stockpiling. So these indicators, you kind of have to take them with a grain of salt. But I'm zoned in on that consumer confidence. And that's one that concerns me. Hey, we've got 55 after the hour. And one of the things is we'll kind of hit some final philosophy, because we want to stay on time, and we want to make sure we abide by that. I guess one of the things that I would say is be a student of credit, the science or the numbers, but balance it with the art of lending, the human behavior. I think that's real critical. I don't care if you're in credit marketing or you're in leadership or whatever. I think it takes a fine balance. Credit issues often start at the top of the cycle. We've had an artificial top of the cycle here. And boy, this is, I'm seeing greed. And you know who the cousin of greed is? Fraud. And one of the things I'm very, very concerned about, some fraudulent activities where we're getting pretty greedy. Business development happens during the down part of the cycle. See it every time because people appreciate relationships. And Tom, you and I've always said, hire for attitude, train for aptitude, but then hold them accountable. And one of the things that I will tell you, a lender with a championship DNA makes training and education a high priority. I just attended my 44th American Bankers Conference, the Ag Conference. And I started when I was 10, Tom. And you know what I saw or what I heard, and it was exhibited? One of the worst management practices in banking. 3 or 4 of the bankers had to pay their way personally to go to the conference. The bank would not invest them. Boy, I'll tell you, that is not a way to compete against a tech company. I can tell you right up front. So, Tom, there's some wisdom. You got any final wisdoms? Because again, we want to be appreciative of people's time. We tried to answer as many questions as possible. Tom, go for it.
Oh, Dave, thank you, and great job today. It's always a pleasure seeing you and working with you. I love what you said about the accountability. Just realize this too, and I think most of us see this as leaders. I've heard a lot this past year, year and a half, 2 years now, about people not wanting to be led. I disagree with that. I, People want to be led. They want good leadership. They want people who are paying attention to them and holding them accountable, but being flexible where flexibility is warranted and being adaptable. That's something that I think in our respective industries that we're not particularly good at all the time. And so I think just being cognizant of that, telling ourselves, as Adam Grant says, to think again and just kind of reflect a little more as people start getting readjusted. So Dave, thank you, and always a pleasure. Thank everyone for being with us today. It's been a great pleasure for us. It always is.
Yep. And again, we tried to cover those 7 areas that I outlined. And John, want to turn it over to you, but to all the alumni, thank you for the continued support of our school, banking school, and hopefully you can send some good qualified students, but we're going to work them hard and they're going to be held accountable. So John, we'll rock her back to you to bring some concluding comments.
Well, thank you so much. Tom, Dave, thank you for taking the time out today to provide us with this timely and relevant information and your insights. We really appreciate it. The two of you never disappoint, and I appreciate you both very much.